Welcome everyone to the average weekly wage subcommittee. It is 1 o'clock, so we'll go ahead and get started. Looks like I don't think we do roll call formally, but I do see Stacy. Hello, good to see you. So I know, kind of trying to kick off, we had some data that came out on this one, looking to kind of dive into some of that and get some discussion going. So I see, first up, the welcome. So welcome everyone. See a couple folks still trickling in. Next up on the agenda, I have data report from WCD, data on states that offer different wage replacements.
Co-Chair Strickland, before we get started, I have two quick things.
Oh, please, Terry, go ahead.
I wanted to make an announcement. The AC is out in conference room 260. So I'm going to recommend that everybody attend these meetings virtually until it is back on, and we're looking at the end of September. So that's just a FYI. Second, I have Katie Bruins with me in the room today. She is the new Deputy Administrator for Workers' Compensation. So I just wanted to welcome her. Okay, back to you.
Thank you for that. Welcome, Katie. Sorry, are you at least not having to sweat it out in the basement? Does the basement AC work?
Basement AC works.
Perfect. Okay. So next up, and I think Summer just came off camera. I assume you're helping with the presentation on the different state data. So feel free to take it away, Summer.
All right. Can everybody hear me okay? Perfect. Okay. Well, yeah, I'm happy to jump into it. So I think you all received a document that's a summary state temporary disability rates before the meeting, and that's got kind of a summary page and a table about some selected states. And essentially what this document is that it's summarizing some information from specific states based on, I think, some information you all were interested in the last subcommittee meeting in June. So I think I heard at that time some interest in learning more about states that have an after-tax temporary, or like a temporary disability benefit based on after-tax, and like what does after-tax mean for those individual states. And I believe there was also some interest in learning about, like, hey, are there any other states that have like variables or factors or something that's affecting what the temporary disability rate is in that state. So this document is my attempt to research that, and so it's not every state in the United States, it's a selection, and it's a selection of states that kind of fell into three groups. And essentially one is just states that have a pre-tax benefit basis that is higher than 66 2/3, because Oregon, we do a pre-tax benefit at 66 2/3. And then the second grouping kind of being the states that do a benefit based on like an after-tax wage. And then the third is sort of a grab bag of various factors that affect temporary disability rates. And it is kind of a mix of different things. So it'll be interesting when we get into that. So happy to walk through that document, or mainly through the summary. I'll leave it to folks to search through the table as they want to, since it's a little long. Couple things before I get into this though, just in case folks are wondering, kind of the sources for this information come primarily from IABC. So they have a work compare database that compiles information about different states and their systems, and including things like temporary disability benefits, so you can kind of quickly compare if you want to. They also do a survey with the Workers' Compensation Research Institute, which also surveys states about their system, about their benefits. I've personally been a part of responding to that before. So taking those two pieces of information, kind of using those as the basis of what each state does. And then in addition to that, in areas where those two systems don't detail something like what is spendable wage in Michigan, for example, that's something I would went and kind of look at the state's website and their specific laws as best I can to figure it out. And I will say that leaves me to one caveat here is that I am not an expert on all states' workers' compensation systems. And as many people know, workers' comp can be complicated. So I've done my best, but if you have questions about like, well, that sounds different or odd, or I want to know more about that, happy to answer. It just might take some additional research to figure it out. And if you hear something from somebody from one of these states, it's like, oh, that's not actually how it works, then you can blame me for getting it incorrect. So that all being said, let me actually get into the content. And if you have questions along the way, feel free to type in or save your question in the end, whatever works. So let's just talk about the kind of first section here. First section here is just some states that do a benefit based on a pre-tax wage that is greater than 66 2/3. And so it's a handful of states, so like Idaho, Washington, Texas, and those rates tend to range from 67 to 75%. Although I would say that's not a strict range because a couple of the states do something a little different. So actually Ohio over time benefits might go down to 66 2/3. And Washington technically has like a range that's like 60 to 75%. So I'll actually talk about those states a little bit more later, but those are sort of some exceptions there. So that's a fairly straightforward section there, not a lot to comment on, at least not that I know of. So the next part is the states that I saw that do a temporary disability based on some sort of after-tax wage. And it's not a lot of states, it's again, kind of just a handful here. So Alaska, Rhode Island, Michigan, Connecticut, Iowa. And they all kind of refer to like what wage they're using a little bit differently, but basically they take some wage number and subtract certain items to get this like kind of after-tax type number that they use. And then they, from what I can tell, would do about 80 to 75% of whatever that kind of after-tax number is. Probably the thing of more interest though is kind of what are they using to figure out the after-tax wage. And so typically I saw about four items. There's federal income tax, Social Security tax, state income tax, and then the Federal Insurance Contributions Act, which I'm just going to say FICA, and hopefully that's the way everybody else says it. But FICA is the one that's, I believe, Social Security and Medicare combined. So each state has like a slightly different combination of like what they include. So not all of these states have all four of these items. And so I kind of specified in the summary, like which ones seem to do which. So like, for example, Alaska seems to take out federal income tax and Social Security tax, but doesn't do state income tax, and they don't do FICA, seemingly, or specify that. One thing I'll note here that if you're looking through the table, that's just a nuance that I noticed but I didn't put in the summary here, is that some of these states, when you look at their laws, they do make some kind of like default assumption about like number of dependents or exemptions you might be taking. Like they'll say something like, as though the worker claimed the maximum number of dependents for actual dependency, that kind of thing. So I'm not going to go deep into that. I'm not a tax expert, but all I'm wanting to note is that sometimes there is like some built-in default about dependents that they incorporate in their laws. So yeah, that's the after-tax benefit states. And then last section is where it gets interesting. That's where, oh, sorry, go ahead, Scott.
Sorry, yeah, just real quick. So to clarify, if I'm hearing you correctly, it's the states will have kind of a statutory definition of these are the taxes that we include and then apply to whatever the data is. Because I know that a lot of times they'll have the kind of weekly wage data, but they don't really run an analysis on that. They do to average it, but then they apply the taxes sort of after that. Is that correct?
I guess that's a good question. It probably depends on the state. I wasn't looking deeply into how they kind of figure out the weekly wage number, because that's its own can of worms, to be honest. Mostly I was just focusing on like when they have a number, like what are they taking out specifically? I do know that like Alaska, I was like poking around their website, and they do have like a calculator that you can look at to like plug in certain information to like get here's what your benefit would be, or like maybe an estimate of it. So some states might have specific tools like that, but I didn't check every single one to be like, okay, which one has which tool to figure things out. I don't know if that exactly answers your question, but that's kind of a bit of where I went with this.
No, it doesn't. And I again, I think the proposal in SB 705 with the -2 had moved away from that kind of after-tax analysis. So I don't know that it's even that relevant, but it was more a point of curiosity as we go through it. So thank you.
I did see a reference Scotland did. I can't remember which state it was, but they were saying that they actually looked at what the employees' W-4 would be. And so it would kind of follow what they would expect to be while they were working. So for one point of reference.
Perfect. Yep. Yeah, I saw that as well. And I know that like the stakeholder discussion a few months ago was partially centered around that and sort of, is it just after tax or is it after deductions, and where does, garnishments or child support and things like that play into it? So good. Sorry to interrupt. Continue.
No worries. Hey, I said to ask questions. No problem. Okay. So last section here are just things that affect the temporary disability rate. And that's just based on me seeing something in IABC's documentation and being like, okay, that looks interesting. Let's look into it. So like I said, it's kind of a mix of different things. So the first one is just dependence or marital status. So Washington is probably kind of the most robust example we have here. So Washington, like I mentioned earlier, the temporary disability rate will range from 60 to 75%, and that will depend on whether you're married and how many children you have. So I believe it's, if you're unmarried at the time of injury and don't have children, you start at like 60%, and then it's like 2% more for each child you have, up to 70%. And then I think if you are married and have no children, that starts at 65, and then it goes up to 75. So they kind of have some pretty specific steps, I guess you'd say, depending on those two factors. I do believe that they had some legislation passed that changes these numbers a little bit, that will start going into effect 2026 sometime. That being said, I think it looks like the range is still going to be the same. It's still somewhere between 60 to 75. It's just changing which circumstance gets which percentage. So just noting that if you were to look into it or saw a change, that's probably why. So that's Washington, kind of the more robust example there. Arizona and Vermont also do some tweaks depending on dependents. Vermont, I believe they add on like $20 a week for each dependent child, though I think that's capped, so the benefit can't exceed 90% of the worker's average weekly wage. And then in Arizona, it looks like they add on $25 a month if the worker has dependents. And I think, if I understand correctly, that is just $25 a month. It's not per dependent like Vermont is. So just a couple states that adjust things based on how many dependents you have. The next item is duration. So with duration, all I'm referring to is if the claim or temporary disability or something has gone on a certain amount of time, there's some sort of time marker where you hit that point and something about the temporary disability rate changes. So to be a little bit less vague, with a more concrete example, for example, Idaho, the generic benefit is 67% of the worker's average weekly wage. And that's for like the first 52 weeks of temporary disability. And then at the 52-week mark, it goes to 67% of the average state wage. So like the basis of the benefit changes at that point in time. Let's see what there were the other ones. Ohio and Texas. So Ohio, their duration marker is like 12 weeks. So for the first 12 weeks, you get 72% of the worker's wage. And then at the 12 mark, you go down to 66 2/3. And then Texas, specifically if the worker's wage is less than $10 per hour, for the first 26 weeks, I believe they get 75% of their weekly wage, and then after that, it's 70%. And I will note, if you're looking at the table, I think there might be like a typo in there. I think it says 75% of the state average weekly wage. And I think that's what's in IABC's database, but I suspect that might be a typo just based on looking at the state's law and going, I think it's the worker's wage. So like I said, I'm an expert, but that's what I think it means. So just a couple instances where duration seems to have some impact on what rate you get. The next item is the date of injury, and this is just 2 states. And basically this is 2 states where it looks like they went from an after-tax benefit and then switched over to a pre-tax benefit. So depending on what date of injury you have, you're going to get a different rate. So with Maine, right now, like if you were injured today, you would get 2/3 of your gross weekly wage, and that's for injuries 2013 onwards. But if your injury was before 2013, you'd get that 80% of after-tax weekly wage. And looking at Maine and kind of looking at these older dates of injuries, and the fact that they do kind of have this after-tax benefit, they also took out like the 4 items that I mentioned earlier, things like federal, state income tax, FICA. So that benefit, as it used to be, kind of fits that pattern of what some current after-tax benefit states do. And then Rhode Island, it looks like they kind of switched things more recently. And so for injuries 22 onwards, it's 62% of weekly wage. And I believe that's gross wage. And then prior to that, it used to be 75% spendable base wage. And again, they kind of take out some of those similar items like FICA and federal and state tax. So just some date of injury affected states there. I do have one kind of interesting thing that I don't know if I fully understand, but I saw it and I thought I'd mention it. Part-time status apparently can come into play in Wisconsin. So if a worker is part-time and they opt to self-restrict, and by that I mean like they're limiting their availability on the labor market. I don't think this has to do with like modifying work. So this would be somebody saying like, I only work part-time, I work somewhere else, just work here. In that case, you get 100% of actual earnings instead of 66 2/3. So that was honestly one that I saw last minute. I thought, well, okay, that's it, all included. And then last but not least, workers' wage sometimes comes into play in a few states. So I mentioned Texas earlier, and that's, if your wage is less than $10 per hour, then you get like a slightly higher rate for a certain amount of time. So I won't go into that again. Yes, I kind of did, but whatever. But for South Dakota and Ohio, I'll talk about those. So Ohio, I believe that if the person's wage is below the minimum, then they can get 100% of that wage. And I will say Ohio is one of the states that looked a little more complicated and took some more looking and head scratching and hair tearing out to figure out what was going on. So I believe, and I could be wrong, that 100% probably is limited by the weekly maximum, which I think limits to either 100% state average weekly wage or the workers, 100% of the workers like net take home pay, whichever is less. So I suspect that kind of 100% is capped to some degree. But that's just something Ohio does if your weekly wage is falling below the minimum. And then in South Dakota, if a worker earned less than 50% of the maximum, so that's the maximum benefit would be 100% of the state average weekly wage, so 50% would be 50%. So if you were to fall below that, then you can get a benefit that's 100% of your earnings reduced by any deduction for federal or state taxes and for FICA. So again, like some of those same items still popping up again in that case. So South Dakota, Ohio, Texas kind of have a few things that affect the rate depending on what your wages and sort of how it compares to some defined threshold. And they specify, okay, if that's the case, then you get something else, something different. So I think that's everything that I noticed of interest. Pretty much all here, so I'm happy to turn it over to whoever wants to talk next. I'm also happy to try and answer questions if I can, as best I can.
I figured some questions may pop up later as folks, as the gears grind away and folks process some. I do want to thank you for putting all this together. I think it was taking a very complicated subject matter and making it accessible to those of us who are not experts in the field. So I want to thank you for your time and effort on that. I think you've done a great job.
Appreciate it.
Any questions yet from folks? Not seeing any. So I see next up we have data report on tax tables of 1971.
That will be Raphael.
Good afternoon, everyone. Thank you, co-chairs and members of the committee. My name is Rafael Robles. I'm a lead analyst with the research unit here at DCBS. And let's see if, well, to start, is my mic working? I was having an issue this morning. Good.
Yes,
And then I'm going to request here to share screen so I can share some of the data I've provided. I guess a bit of context, I believe it was the last meeting, and I believe it was Co-Chair Lewallen who asked for a comparison of 1971 tax rates to see if maybe that would help explain where this magic 66 2/3 number came from. So I did some sleuthing and some history to try and find out what things would look like. Here we go. Okay, so this is going to be looking at both the 2024 and 1971 tax rates for comparison, as well as the payouts and how they align with one another. I decided to use the same example scenario workers that were previously presented at the larger MLAC meetings a few months back, which included 5 workers along with a worker making the Oregon state average weekly wage. And because worker 1 was based on the minimum wage in Oregon 2024, I also added a worker making the minimum wage in 1971, so we can have a comparison point. That, of course, in 2024 is below the minimum wage now, so it doesn't make as much sense, but it works as a comparison at least for what an individual's experience might be like. So minimum wage worker in 1971 is making $1.25 an hour. The equivalent now would be $9.67. However, the minimum wage now, or in 2024, was $13.70 an hour. Couple of the workers making $29,000 a year, $37,000 a year, $58,000 a year. The state average, however, I didn't do conversions based on cost, or I didn't do inflation conversions between 2024 and 1971. These are the state averages in those individual years. So for instance, the state average earner in 1971 was making about $7,124 per year. If that was adjusted for inflation, it would be around 58. So the state average weekly wage actually outpaced inflation by about 25% now. I guess another way to look at it was someone making the state average weekly wage now would be making around $9,000 in 1971 as opposed to $7,000. This data was presented previously, the 2024 tax info, but I just wanted to kind of bring it back up and give a little additional context. This is doing very basic taxes. There are other components that could go into one's taxes, additional deductions, a bunch of various tax credits one might qualify for. You don't have to take the standard deduction, you can itemize. However, most people do take the standard deduction, and in order to be consistent, I didn't include any additional tax credits or deductions such as retirement contributions that may apply. So in 2024, the federal standard deduction was 14,600 for an individual, or twice that for a married person filing jointly. And in 2024, there are no personal exemptions, so no deductions for yourself or family members due to the Tax Cuts and Jobs Act eliminated those. The tax rates started at the lowest tier at 10% and then are progressive taxes up to 37%. For Oregon, the standard deduction was $2,745 for a single and twice that for a married filing jointly person. And Oregon taxable income does allow subtracting a portion of your federal tax liability up to a limit, $8,250 for a single person makes up to $125,000, and $8,250 for married filed jointly as well. None of our scenario workers will apply for that. One change from the previous submission of this is personal exemptions for Oregon. Personal exemptions in Oregon now work as a non-refundable tax credit rather than a deduction. In the previous one iteration of this, I didn't include that because it was a tax credit and we were eliminating credits, but I did include it this go just so it would be a little more one-to-one when we get to 1971. And then finally, there's the FICA. I'm going to tomato this FICA instead of FICA just because I won't remember to switch it if FICA is correct. So FICA is 7.65% between Social Security and Medicare for individuals, up to a max taxable income of $168,600. Again, none of our example workers will qualify for this. And this just kind of does the math breakdown for all the different scenarios. You take their gross income, apply the federal standard deduction to get their taxable income. If that is 0 or lower, they owe nothing. And then you apply that taxable income and to the federal tax brackets, which are progressive. You take tiered systems, your pay up to a certain point at 1%, pay up to the next level another percentage, and so on until you hit the max. And then once I get the tax amount, the tax liability, I divide that by the worker's gross salary to get their effective tax rate. This applies for federal amounts and for Oregon amounts. And then for FICA, it's a flat amount because none of these individuals make above that limit. So it's 7.65%. For individuals, the federal liability ranges from 5.04% up to 12.19%. And the Oregon effective rate ranges from 5.54% up to 6.93%. And then for married individual married with 2 children, it could be anywhere from 0%, no taxes owed federally, up to 7.23%, and in Oregon 1.47% effective tax rate up to 5.62%. You add those all up and you can get their total effective tax rate. And we see here that those range from 18.23 up to 26.77%. So not quite, even at the individual level, not quite up to the what would be 33.33% if the 2/3 paycheck was kind of a 1-to-1 area. For married with 2 children, that effective tax rate is much lower, but this also assumes that the worker is a sole provider. So there's no additional income. If their partner had additional income, it would change the effective tax rates. Something else worth mentioning on these is, again, these are essentially conservative estimates of the effective tax rate. if the worker had additional deductions for things like retirement credit, retirement contributions, or if they had additional credits they qualified for, that would lower their effective tax rates. So this is essentially a highest worst case scenario.
I
So
would
now
say that that's true aside from paid family leave, worker benefit fund, transit tax, all those additional taxes that are now in effect in 24, 25 that weren't in effect in 1971. So just putting that out there for consideration as well.
Thank you. Yes, there's a lot that can go into these. So then we get to the 1971 rates. In 1971, the tax brackets were much more extensive. They started at a higher rate. The lowest federal bracket was at 14%. For comparison, once you adjust for inflation, the tax bracket now would come in at 17% then, or 10% at 500 or at 16,000 would be 1-to-1 with this 17% tax rate is where we'd come in. The standard deduction for federal and for Oregon, Oregon's tax plans kind of matched for the rulings, was 13% of one's adjusted gross income or 1,050, and they did whichever one was greater. You'd have to make over $8,077 for that 13% to come into play. So for most people, it was $1,050. Federal and Oregon personal exemptions were $675 per person, and these were applied as deductions rather than credits at the time. FICA wasn't formally adopted in 1971, but there were Social Security and Medicare type taxes. So for Social Security, that was 4.6% up to $78,000. And for Medicare, it was 0.6%, so a total of 5.2%. We do the same basic calculations. You apply the standard deduction to one's gross income, add the personal exemptions, find the taxable income, apply the tax brackets, and we see the effective tax rates for federal and Oregon. For the FICA, this is mostly 5.2%. However, the example worker number 5 made over the limit, so their effective FICA tax rate was 3.94%, slightly lower. So then we get to the comparison. This is just total effective tax rates. For singles, individuals, it ranged from 11.54 up to 26.91. And for married, it ranged from 5.2 to 18.12%. As we compare these, we see that for overall, lower income workers, those below state average, ended up with lower effective tax rates in 1971 than in 2024. As you get to the higher wages, this does start to switch and the tax rates go a little bit higher. But we see across the board, this doesn't get near the 33.33% effective tax rate. That would make a 2/3 paycheck payout equivalent. Once we take these and do comparisons, I wanted to see how these compared to the take home at that 66.6%. Again, for 2024, this was presented previously. We see that across the board, someone on the temporary disability payout would be making less than they would with their weekly take-home estimate. Caveats to that, though, this weekly take-home estimate does assume that the worker perfectly estimated their paycheck deductions so that at the end of the year they would owe $0. I know personally I have more taken out, so I don't end up owing at the end of the year. So that would be a different scenario. It's pretty rare for someone to perfectly calculate it, but we use that as just a baseline estimate. We do see at the lower end, so a single person is taking home about 18.5% less through those disability payouts than they would for a taxed income. For a married individual, that's even higher because they would be taxed less in the end. That take-home difference does decrease as we go up the income brackets, and that's because their tax liability would increase as well. So their effective tax rate increases, so the difference gets less stark. We do the same with the 1971 disability payouts, and these are a little bit different because of the minimum and maximum rules that were applied during 1971. So the numbers, Summer reported during the last meeting, during her historical kind of trackdown, was that the payout minimum in 1971 was the lesser of $50 or 90% of one's average weekly wage, and the maximum was $85 per week. As a result, we see most of our workers are hitting those minimums or maximums, with only worker 3 kind of coming in at this actual 66.67%. We see someone working full-time, making minimum wage in 1971, theoretically would pull in an additional 77 cents a week during temporary disability. I don't think that would be the case in effect, but using the numbers provided, that's kind of how it would break down. So it would be fairly equivalent. But for the most part, in 1971, workers would also be taking home less from disability payouts than they would during their post-tax in earnings. And these rates are actually quite stark at the higher levels, up to 54% for a married worker with 2 kids making the highest amount, $10,737 per year. And that's due to the maximums in the maximum rates for disability. I believe in 1972 or 73, if I'm remembering correctly from Summer's presentation, they did raise that maximum because it was so much lower than what would be expected for an average worker.
Yeah, was I looking at this correct, Raphael? And maybe it's this with the next slide actually might be a good one, but just making sure I was looking at this correctly. In that if we're looking at what folks took home in 1971 with the disability piece, it was actually less than what people would be taking home today. In most cases, I think there were 2 cases, 2 or 3 cases where it might have been a little less, but for the most part, everyone would have a higher percentage taking home than in 1971. Is that true? Did I look at that correctly?
Yeah, so
Okay.
we have the comparison here, and that's correct. So at the very high levels, in 1971, someone is taking home 43 for an individual to 54% less than they would from just their taxable income, normal earnings. Whereas in 2024, that difference is only 9% to 16% less. At the lower levels, I'm going to ignore the 1971 minimum because it doesn't really apply to 2024. But it would be 18.5% versus 15.7% less, and then 26.6% versus 29% less. So they would be keeping a little bit more. It wouldn't be as much of an offset in 2024 as comparison to 1971, which I think was surprising to me. As a result of just kind of being surprised by that distinction, I did want to just add a little bit of context, and that's based on payments or expected expenditures for these workers. The primary one being one of the biggest expenditures people is rent. So I looked at the median monthly rent in 2024 versus 1971 to see what that paycheck would be going towards. And we see that the median monthly rent in Oregon this is for a 2-bedroom apartment. In 2024 is $1,646. In 1971, it was $107. This is a huge difference because it actually doubles the inflation rate. If rent simply increased based on inflation, 1971's rent would only be about $829 now in 2024. So it's more than doubled. And as a result, we see that after those payouts, a minimum wage worker in 2024, after payouts, would not be able to afford their rent. Their rent would be 104% of their monthly income. And that's taking an average of their weekly rate for the year and then dividing it by 12 for the monthly. Now, this isn't I do want to point out that this isn't a disability payout issue on its own. It's also that wages aren't necessarily going up with inflation or with rental prices, I should say. But we do see that as a result, someone making minimum wage in 1971 could still afford their rent. For those first two workers, worker 1 and 2 in 2024, they would not be able to afford rent on disability with their estimated taxes applied. It would be the majority of their paycheck, about 85% of their paycheck, but they would still be able to afford rent, just total, with just not much money for additional expenditures. It's only those making the higher wages above the state average weekly wage that in 2024, the disability payout would be adequate. And what I mean by that is most rentals and most economists recommend 3 times that you should make 3 times your rental payment. That makes sense. Your income should be 3 times your monthly rent.
Yeah,
So
I agree that those numbers are stark. I think like what you had said earlier, it's definitely a broader problem than, or a broader conversation or issue than the disability payouts. But yeah, definitely some great data here. Thank you.
but that's all I have. So if there are any additional questions, I'm happy to answer them. What I can. I do want to say I'm not a tax expert either. This was a nice learning experience, and I feel prepared to do my taxes next year.
I think you did a great job compiling it. Thank you.
Yeah, thank you. And I think it's interesting the data seems to kind of show that there were some improvements made to correct for higher income folks to kind of increase the thresholds to allow a little more there, even when kind of dealing with the rent issue, which I know, home ownership may have been a higher percentage of folks then. But it's interesting, and I'm glad that we brought up the housing issue, because I think that a lot of folks dealing with the housing issue, dealing with health insurance, dealing with retirement, dealing with childcare, that those rates kind of have skyrocketed as a percentage of their total income. And I thought that was interesting that even the worker in situation, or worker number 5 making above the state average weekly wage still does not meet the affordability threshold of a third of your income going to rent, whereas 3 out of the 6 scenarios in 1971 did, and almost everybody except the minimum wage worker was at least within the half. So it's like a third to half. A third is considered decent, and affordable. Half is considered sort of the bleeding edge of what you can get credit for. And that anything beyond that's considered such a credit risk that you're not going to be able to receive a loan or financing on that. Whereas now, the vast majority of folks are in that threshold now. So I think that is very telling. And I thank you for raising that issue.
Of course.
Any other questions on that one? Thank you again for putting that together. That must have been an interesting rabbit hole.
It was, but I enjoyed it.
Good. questions on that information? Again, we may, I know, have some things that bubble up in discussion moving forward. I see next on the list for the agenda is the data on duration of temporary disability claims. Is it my understanding that we don't have that finalized yet?
That's correct, Co-Chair. That data, we're gonna need another week or two. So that'll be ready at the July 25th meeting, along with a summary of long-term and short-term data. Hope, that's my hope. I'm not gonna promise anything. Yes.
No, of course. Next up, I see policy discussion just on average weekly wage for low-income workers. I know that we had some great presentations and information from AFSCME as part of SB 705 and kind of talking about the impact and the concerns and the workers writing in and talking about the issues with that. I think the information that we received from WCD, thank you again so much for that, is pretty stark, especially in terms of housing affordability for lower income folks. And again, I think that would be magnified if you're dealing with childcare and other kind of high cost issues. Just wanted to kind of hold some space for that discussion. I don't know, Stacy, if you had any kind of thoughts about the data or where we're at. I am happy to kind of lead and sort of push forward with some of my ideas, but I don't want to monopolize the time.
Yeah, I thought the data was great. Again, I'd like to reemphasize that I think it's more, some of these things are more systemic, which are not something that we're here to solve today, or this committee is going to solve. But I think the data was good. I think there's a lot of good reference points that we can incorporate into the discussions and get things moving along in terms of how things got started, comparisons to other states. I thought it was interesting in looking at the states that did have higher percentages. I think almost, if not all of them, had lower average weekly wages. And so Oregon seemed to be on the higher end at 133%. Most of the others, like New Jersey, Ohio, Oklahoma, Texas, Washington, they were anywhere from 70 to 100% to 120%. So just kind of interesting to see how they did the give and take when they're setting some of those rates. So again, I think the information that Severin Raphael put together was awesome, and we can really incorporate that into what we're trying to figure out how to tackle this. So that's good stuff.
Thanks. Yeah, I think that's a great point, and I think it is interesting. It does seem that there have been some sort of intentional approaches to correct the calculations. Well, I would say correct to increase the payout amounts to middle and higher income folks. And it looks like there wasn't that done for the lower income folks over that same time period. And maybe there's an imbalance there now. And I did notice that. And it was interesting too, because in a lot of the states that had even higher sort of payouts just on the sort of average weekly wage calculation numbers, I think the housing information and the piece there would be pretty interesting, because I know a lot of the states have much more affordable housing available, or land is cheaper for a lot of folks. So I thought that was interesting and kind of telling as to why the stakeholders have brought this issue kind of focusing on the low income angle in particular, as we can see. But, I would worry about disincentivizing folks from filing claims if it's known that they would not be able to afford their bills, even rent, if they go on work comp, and that then there would be some kind of tracking of that, right? So that once you're put on light duty and or disability, and then forced into having such a huge reduction in pay and no longer able to pay your bills, I would think there'd be a lot of folks that just would make the decision that they're not going to do that. They're going to work injured. They're going to just sort of, fall into unemployment or do something else, work under the table, whatever it is that they can do. So I think it's really good that we have this issue in front of us, because I really think this kind of is a piece of something that goes at the core of undermining the system and just sort of disincentivizing people from filing claims to begin with.
Agree. I do want to say, I think that the work of this committee needs to have a balance, though, because we also don't want to incentivize people to stay home. There's many studies that show that folks don't recover as quickly as they can, and there's just some more detrimental attributes that occur the longer that folks are at home. And so I think there needs to be a balance between understanding what is currently causing decentivizing people, because agree, we don't want that, but we also don't want to have the pendulum swing too far and then start incentivizing people to not work and get back to normal daily life where they are productive members of the society and able to continue contribute and feeling that benefit from being able to do so. So I think there's going to be a balance that we have to evaluate as we do this work.
Yeah, and I would agree wholeheartedly that folks re-entering the workplace and getting back into work and doing that is a valuable part of recovery. And from myself and my experience, it was really important to be well enough to get back into doing things. And I was in a position where I was the locksmith for 36 different facilities. And so to be able to provide support for my coworkers, for the facilities, for the folks that were living at those facilities was critically important, and even be able to do things around the house again. The one thing that I would say is the amount of pay that I received didn't incentivize me one way or another, because the decision wasn't up to me. It was up to the doctor and the medical providers as to when I was well enough to return to work. So I do want to flag that as an issue unless people can lie, people can fake things for sure. But I would say that given the data that we've received today, there is an incentive for people to lie and go back to work too early too, which is also, I would say, equally as dangerous. Either they don't file the claim, or they file the claim not knowing the extent of financial difficulty that they'll face, and then are, not being honest about where they're at in recovery and in going back to work too soon and having difficulties from that as well. So I think just kind of framing that and understanding that is important. And that's something that I was confused by, because I know that there were some of the stakeholders that gave presentation, or in their presentations would mention this idea of incentivizing people to go back to work, which again is not up to the worker to decide once they've filed the claim and are in that system. So was confused about that when that was brought up previously.
Yeah, I think we could be going down a rabbit hole. I think we each have different experiences and have been party to different things. And so I think really just focusing on, I think part of our charge should be focusing truly on the issue at hand, the wage piece. I think if we bring in a bunch of external factors, we could each argue a lot of different things, and I think we could probably go down a rabbit hole. So it'd be good to maybe set some focuses for how our work group works once we start those discussions, and just seeing how that could go. Just my 2 cents there.
Can I talk to you about the data real quick? Is this a good time?
Great time.
Does that work for you, Scott, Coach Strickland?
Sure.
Okay, so one thing that we could talk about is some data related to fraud in the system, which might bring some of this to light. So that's one idea. The other thing is there are I went back to the June 13th meeting, and we have captured a lot of data, but there's some data that we do not have. There is not data related to the loss of healthcare, PTO, or retirement in a work comp claim. There is not data related to the delay in payments to injured workers, the time loss payments. There is not data related to, there may be some the insurers collect on injured worker survey data. There is not data related to everyone's individual situation. So everything else that you asked for, we've been able to deliver. But those are a few things that we might wanna, I just want you to noodle on, because we're gonna have to get creative about the areas that we don't have data. And if you would like me to reach out to the insurers and ask about fraudulence in the work comp insurance realm, I'm happy to do that. So that's just to you. You can get back to me and let me know, because I'm happy to do that.
Yeah, and I think that's helpful, and I think it's helpful to kind of frame the ongoing discussion that this is kind of a twofold thing. There's a policy element here that may be anecdotal, maybe just sort of a policy discussion. There is a data piece that's important that we've gotten tons of good information on. I'm sure we'll continue to get some information and feedback, and the anecdotes in aggregate do become a part of that data discussion as well. But yeah, I think it is important, and I know we heard from a lot of stakeholders during the last few months of kind of having this discussion around SB 705 of it, you know, asking these questions about what data is collected, where are the sort of blind spots on this as well. So yeah, I think that's valuable and helpful to take a minute and recognize.
Right.
Any other? I don't mean to just have this be, you know, when we have the full panel of MLAC, it's a little more kind of holistic perspective maybe on issues. I don't mean this to just be Stacy and myself commenting on our thoughts about it. Any stakeholders, you know, welcome to listen to some feedback on the policy position.
It's a quiet group today, co-chairs.
Friday afternoon, folks are probably, you know.
Oh, I do see someone from Cedric. Thais?
Yes, Thais.
Hi, sorry. I just wanted to chime in, I guess, a little bit before things break up for the day. The Sedgwick's position currently is sort of twofold. One, there was a lot of work done in the state less than 10 years ago to try and establish an average weekly wage that is fair in how to review for that. I did forward some documents after that last committee meeting that were created as a part of that process to show how to calculate that base rate, average weekly wage in the state, that came out of those committee meetings and are part of the current rule. So we would encourage this committee to maybe not rethink the wheel on how to calculate the average weekly wage itself, but to look at what percentages and how to structure those percentages of that rate for payment to injured workers while they are off on time off. And Sedgwick would be fully in support of coming up with a tiered method of looking at that average weekly wage percentage based on income factors, et cetera, as those discussions are happening.
Gotcha. So just, again, it is Friday afternoon. Let me feed that back and make sure that we're receiving it.
Yes.
Not as interested in a shift to a post-tax, pre-tax sort of reinvention of the structure, open to a let's keep the structure we have, maybe do buckets, you know, or a threshold, or just change the 66 2/3, but keep the weekly wage calculation. Is that more or less?
Yes.
Thoughts
yes.
right now? Okay, great.
Yeah,
Thank you.
especially looking at that minimum that really has not changed within the rule. it's just silly to say it's going to be 90% or $50, especially in 2024. But if it were for this state of injury, state of average weekly wage was X. If you make below whatever percentage of that state average weekly wage, then we'll pay you this increased percentage of your average weekly wage for your time loss rate. I think that could be more plausibly applied and more fairly applied. And frankly, the examiners trying to do this work are very overtaxed as it is already. So keeping in mind any changes to those processes as far as how to do the job on a daily basis, it will affect everyone. Yeah.
Understood. Yeah, thank you for that. I think that's helpful in guiding the discussion as well.
Thaddeus, you sent me that industry notice, right?
Yeah, it was shortly after we had that last meeting, but if you need it, I can always pull it up again. I've got it on my desktop.
No, I just wanted to let people know it is on the subcommittee website. You sent it to me, I posted it on the website, so, okay.
Thank you.
Thank you.
Great, thank you. I think it was Kirsten had a hand up, but the hand's down. I don't know if you were just wanting to reiterate or.
Oh, yeah. Well, when Thais was kind of going had some interesting points, so mine weren't related to that, but I just kind of wanted to echo, well, first of all, thank Workers' Comp Division for all the work they've done putting into this data. And I think it's really helpful to see all of that. And then also just kind of reiterate what the kind of conversation you and Stacy were having. I think it's really, this is a really great opportunity for us to sort of dive into where that sweet spot is for these calculations. And we're both kind of talking about that. So I just wanted to chime in and say, we really agree that this is a place to have those conversations. And I think we can come to something where we're looking at sort of the reality of how things have changed since this was initially set. But then also, to Stacy's point, realizing that, we can't change all of the systemic issues that go into the changes since the 70s, but, what we can do to make sure that folks are getting what they need from the system, but then also making sure that it's, staying within what the original intention was. So yeah, just wanted to say thanks for the work that's going into it, and glad to be part of these conversations.
Thank you. Other thoughts or discussion on this? If I can boil down, Stacy, tell me if I'm misrepresenting here, but folks should not be disincentivized from filing claims by earning too little.
agree.
We're on board with that at least. Okay.
Yeah, but should not be incentivized to not come back. So we got to find a balance.
Okay. All right. Any other policy discussion? I see we have 30 folks in the room, and I want to make sure that no one's desperately trying to connect their microphone so they can chime in or anything like that. So if not, I see next up on the list, anything else that should be included. I think we kind of already had a bit of that discussion with data, and Terry made a great point about sort of, the information that is and isn't available or isn't collected. I know we've had some outreach to, I think, some of the insurers, or at least a discussion about sort of data about surveys and things like that. I know folks from OTLA and Northwest Workers Justice Project and the Ombuds for Workers probably have a lot of, again, data in individual aggregate kind of a thing. Maybe kind of having a little bit of back and forth on that, I think would maybe be helpful. I don't know that we'd need to kind of devote a whole meeting to it, or if just kind of getting some of that together and out to stakeholders and folks would be helpful.
Yeah, another thing that I was thinking, and I think Terry touched on this a little bit ago, but what would be helpful is just understanding the percentage of population falling into these different ranges, understanding what are we talking about here, where are most workers falling within the the compensation buckets or, you know, whatever tiers levels we want to look at there. It'd be helpful to understand that just too, as we're trying to, because the next piece of this will be trying to understand the impact that we're doing to the system, right? And so having some of that information would be helpful as well.
No, I think that's a great point. I know there was some of that. I think a little bit of that WCD had put together. And then I think also, I think NCCI maybe referenced some of that data in the report that they had, but yeah, having that on one page is always nice as well. So.
Also, I was just thinking we could have a, I can't think of a better way, show and tell. Everybody could come and share their information, like the ombuds and OTLA, and everybody could tell us exactly anecdotally what they're hearing. Because if they have information, but it's not collected, it's all anecdotal. We might just have a sharing is caring meeting, for lack of better words. So maybe we need to put that on maybe our August 8th meeting or something. Is that a good date for you two before I throw it out there? It's you, okay. Let me check with Stacy.
I'm looking here. Yes, I'm good. I'm good that day. Thank you.
Yeah, that works for me. And I know, you know, we had the injured worker panel, and I know there was the individual that talked about that, you know, cost of delayed payments and credit and all of that, and the difficulty that he had gone through, which I think, Terry, that was another good point that you referenced, was the sort of, there's no collection of the cost impact of payment delays even. But yeah, I see Keith has a hand up.
Keith Semple, OTLA. I know we're being called upon. I'm just kind of digesting the information and thinking about, you know, where in between the legislative proposal and the current status quo we might end up. So I can't say I can come to the table with, you know, all the anecdotes and kind of who falls where. I can definitely tell you that people are hurting. But I understand that is from a variety of factors. And it would be very helpful to, you know, not only consider, you know, the tax and the percentage of take home, but also what it goes to, you know. We can definitely make ourselves available and provide as much anecdote as we can, but I wanted to make sure that everyone knows we're listening. I'm here, I'm listening. I don't just, I don't just have it on in the background.
No, of course, I figured, and thank you for that. And I think that brings up a good point too, with the sort of how we progress forward. I know we'd had some discussion of, you know, MLAC doesn't write laws sua sponte, and I think kind of, you know, the last thing that we'd left off at was the SB 705. I think the -2, I want to say, was the latest. And I know that was sort of like the discussion piece. So I don't know if kind of orbiting the discussion around that would be helpful, of that being, you know, where are there deficiencies? Where is there agreement? Where is there somewhere where we could move forward on kind of from that? Would be a constructive way. We had a stakeholder bring that specifically, work on that specifically, the stakeholders still here engaging on it. I think that might be helpful. Not that that's where we're going to land, or that we won't, you know, go this way or that way or whatever, but I think in terms of kind of orienting the discussion, that might be helpful to start with that. And I know some of the stakeholder feedback on it was, again, you know, okay, we're getting closer to something that may be workable, especially with the -2, but sort of, you know, next steps and how could we, what do we think about progressing forward with something relating to that? And I know that's always helpful if another stakeholder brings a legislative concept, that there's sort of a scaffolding in place, or, you know, bare bones there that we can work with. So just wanted to throw that out there. I don't know, Stacy, if you had any thoughts on that.
No, I think that's a good idea. I think kind of what I touched on earlier, it feels like we need to make sure that we don't let ourselves go down rabbit holes, because I think there's so many directions that we could just naturally go with this thing. And that might be a good centering spot. And then we can just start using that as kind of our focus point and making sure we stay into that narrow lane and not venture out into all the things that this could wind up talking about. So I agree.
I'm totally with you. So refundable housing tax credits paid out of education
That's
loans.
not our realm, Scott, not our realm. Narrow.
I'm so sad that no one has their camera on, that I could have seen the, people dropping what they're doing and being like, whoa, guy, calm down, please. So, but anyway, yes, no, exactly. Point received and agreed that, if we keep within the bumpers, we're able to then kind of make some progress on something in terms of constructive feedback for, is this something? If it is, how do we move forward on it? I think that's great. So, last thing that I see, public comment and stakeholder feedback. I know we've been sort of opening that up repeatedly, but just wanted to hold some space here for any of that. Happy to hear from folks.
I did not have any co-chairs. Nobody emailed me.
Okay.
I was gonna say, I think people want to get to their Friday afternoon.
No, of course, and I won't deter much longer. The one thing I would say, I know a lot of folks, myself, I tend to take a little while to process the information, so I like to get something and then kind of think about it, and I'll wake up in the middle of the night and have an idea, write it down, and then a week later actually process into something coherent. So I would really invite, especially in subcommittee work, any written, if folks want to prepare statements, if folks want to submit statements, if folks have kind of, you want to do written comment instead, we welcome that. I think that's really helpful for us, especially kind of leading in, that we can see and know where some stakeholders are. And as we're preparing for meetings, I know, putting agendas together and other things, we're able to kind of draw some of those issues out. So do want to welcome folks to kind of submit on that. If this venue isn't as accessible for you, do welcome that. We do read all of it, every page. So, happy to have that format as well. Aside from that, I will not keep folks from a sunny Friday afternoon. So I want to thank Stacy and everyone else, and look forward to continuing to work on this. I guess one flag, we are slated for the 25th, but it will likely be a short meeting with just data presentation. So did want to give folks a heads up about that. And then sounds like, a fuller meeting on the 8th. Tentatively, everything, Great. Thank you, everyone.
Thank you all. Take care.
Thank you.
Good weekend.
You
Thank
too.
you.
Bye.
Bye.